Well, good morning. This is Steve Bruno. I am Chief Investment Officer here at 12 Points Wealth. We are convening for the last webinar of 2023, and we are joined by Bryce Gill, who's an economist at First Trust. First Trust is a firm that we have a number of different investments with. And Bryce is going to share some of their insights, both in terms of the current economic environment, and then we'll get into how that shapes the outlook for 2024. Take it away, Bryce.
Yeah, well, hey, absolutely. Thank you, Steve. It's great to be with you and your clients here this morning. Obviously, it's been a very volatile couple of years with the stock market and also the bond market as well. Interest rates bouncing all over the place. Talk a little bit about that. We'll talk about what's causing it, how we got where we are today, and kind of what to expect as we head into next year. But before we get into it, I just want to say, hey, Merry Christmas, Happy Holidays to everybody. Really appreciate you taking a little bit of time out of your Friday at this time of year to spend that time with us. So, guys, it really has been an interesting market environment for the past few years. It all sort of started with COVID, but we're kind of in a different ballgame these days. And the big reason why is the inflation challenges that we've been going through as an economy. We've been dealing with the highest inflation in 40 years. We've seen a lot of progress this year, and I'll talk about that. But this is the polar opposite environment for interest rates now, because anytime inflation surges, the Federal Reserve is going to step in and start hiking interest rates aggressively. And we've seen the fastest increase in interest rates since probably the early 1980s this year. And when we compare today versus really the decade, really 15 years, I guess, after 2008, 2009, well, things have changed completely. Back then, it was all about 0% interest rates. We had never really gotten inflation above 2% consistently for that entire 15 years. The idea at the Federal Reserve or in Washington, D.C. was, hey, let's keep interest rates really low. Let's print a bunch of money because there's not really a downside. We haven't been able to ignite inflation. It's kind of a problem that's in the past. We'll never have to deal with this again. So, hey, what's the downside to running interest rates really low and stimulating the economy, especially during huge events like COVID-19? Obviously we were printing a lot of money, and I'll talk more about that. But we realized as an economy and as policymakers are sort of on board with this now too, that 0% interest rates are a big contributor to the inflation that we have. And so that environment of really accommodated money, very low interest rates, where you just buy an index fund and it goes up every single year, that sort of disappeared. Higher interest rates make the market more volatile. And I think what we're in today is not just a market where every stock goes up every year, but instead, we're kind of looking at a stock picker's market. I mean, last year, what did we see? We saw interest rates surge and the big tech companies sold off, and the only safe place to be was really in value type investments, which hadn't outperformed growth or tech stocks in forever. And then this year is more optimism about inflation improving has saturated the market. Well, it's been the opposite. We've seen the very small amount of stocks, about 7 stocks, drive the vast majority of the returns in the market. So those same tech stocks that sold off last year have now rebounded heavily this year. So you can see just a lot of volatility. It's a very small amount of stocks that you have to pick to really outperform the broader market. And I think that volatility is going to remain here in the future. I'll talk a little bit about why as I go through my presentation. And then I believe we're going to have time for question and answer at the end of these prepared comments, guys. We've got about 20 minutes of prepared comments for you. And at that point, just because there's no way I can talk about everything going on out in the world in 20 minutes, please feel free to bring up anything that's on the top of your mind. We do not have to keep it to just the specific points that I'm going to make here in regards to the stock market directly. Okay, so with that, Steve, if you wouldn't mind clicking to the first slide here. It should be the M2 money supply slide. Okay, perfect. So, guys, like I said, the really big difference between today and really, I guess, pre-pandemic is the huge shift in inflation. And, I think inflation has just been massively overcomplicated the past several years. I don't think inflation is that complicated of a subject, even though, economists, politicians, news pundits try to make it complicated. I think inflation is just too much money chasing too few goods. It's exactly what you learned in Econ 101. And when you think about what we did during this pandemic, well, hey, we printed a whole lot of money and then we shut down the global production system, right? So there was fewer goods and there was more dollars. This is the I guess textbook cause of inflation throughout history. And so it's still surprising to me how many people, were completely blindsided by what we're going through. And, at First Trust, we were one of the early, I guess, groups to warn people about this inflation. And a big reason why was the too much money side of the problem. I think this was the initial red flag. And that's the chart that I have on the screen here, guys. What I've done is I've charted out the growth rate of what's called the M2 money supply over time. So what this chart shows is how fast the amount of dollars in the United States are growing at any given point in time. Okay, and I sort of have like a 60-year average. So you can kind of see, hey, what's like normal? It's right around 6% a year. Okay, and so, hey, why do we care about M2? What is M2? Why should anybody care about this esoteric economic statistic? This is what we call high-powered money. It's dollars in people's hands. It's checking account balances, savings account balances. We care about dollars in people's hands because, if money doesn't get into normal people's hands, if we print a bunch of money and it's buried in the ground, it obviously can't affect consumer prices. And so that's why we look at M2. And what you see is during COVID-19, we saw the fastest growth in high-powered money by far in modern U.S. history. I mean, it puts the bad old days of the 1970s, the early 1980s, when we're printing money to pay for Vietnam and the Great Society programs to shame. Okay, and you can see it jumps off the screen at you. Obviously, a huge spike in the money supply, and so pre-pandemic until the peak, we essentially saw the amount of dollars in circulation in the United States expand by 40%. And the reason why this happened was we printed $5 trillion with a T, and then we sent checks to everybody in the country, right? Stimulus checks, boosted unemployment benefits, PPP loans, sort of go down the list. And so I think a big reason why inflation got as bad as it did is we just pumped a bunch of new dollars into the economy in sort of an unprecedented, quick way. And that's what this chart shows. And so the good news on all this, guys, by the way, hey, that surge in inflation that was sparked by this led to the huge surge in interest rates over the past, year or two here. That's a big reason why tech stocks were selling off last year, why the market had a bad year last year. This year, it's been sort of the mirror image of that because the Federal Reserve stepped in, they raised interest rates, we tightened monetary policy, we stopped sending all these checks out, the pandemic, emergency programs are over. And what you can see is just as fast as that money supply grew, that growth rate has fallen dramatically as well. And so in the past year, we actually haven't seen the money supply grow, it's actually shrank slightly, okay? And so what that means is, and by the way, guys, the good news on inflation is we've seen that headline inflation rate fall from about 9% down to about 3.5%. Okay, so we've made a lot of progress on the inflation rate. Prices are still going up. They're just going up much less rapidly. Okay, and I think a big reason why that comes down to the too much money side of the problem. The chart that I have here, we've just stopped printing and adding all this new money to the system. We basically stopped throwing a bunch of fuel on the fire, fuel on the inflationary fire. And I think that's why we've seen so many improvements here. And so the good news is, hey, the Federal Reserve is probably done with rate hikes. That's my view. Okay, so at least at the short end of the curve, we're not going to see another big spike in interest rates. Now, the long end of the curve is sort of a different story. And guys, what I'm talking about when I say the curve is the yield curve, right? There's different bond maturities. So you can buy like a very short-term bond, or you can buy one that matures in 30 years. And those interest rates are, typically different based on, the risk that you take lending for a longer period of time, right? And so we're seeing a lot less volatility, I think, at the short end of the curve, but hey, interest rates at the longer end of the curve, like a 10-year treasury and above, those have been bouncing around like crazy here. And I think will continue to affect the market because at the end of the day, the price of your financial assets, stocks, bonds, it really comes down to profits and interest rates that go into those prices. So, Steve, if you want to go forward to, I think it should be 2 forward. It should be the reshoring boom slide. Yep, this one right here. Perfect. Thank you so much. So, hey, we've seen interest rates fall a good bit here in the past couple of months. Inflation has come down. Why am I not saying, hey, it's time to just get really, really aggressive? I don't think there's this new huge bull market that's started yet. I still think we have some volatility of prices ahead in the economy. I think next year, we'll see probably a correction in some of those really big tech names again, would be my guess. Okay, so why is that? If inflation keeps coming down at the rate it's been coming down, the problem's basically behind us. Why wouldn't the Fed be able to cut back to zero on interest rates? Well, part of it is the fact that the 0% interest rate policy eventually sparked the inflation that we just dealt with. So they're going to be cautious about getting that accommodated with monetary policy again. But I think the other part of this is there's a lot of sticky inflation underneath the surface that's going to be harder to fix longer term. And so, guys, the Federal Reserve has a 2% inflation target. Inflation is still roughly twice as high as that, right? And I think though we've made a lot of progress, I think this last leg of the inflation fight is actually going to be sort of the toughest to deal with, okay? And there's some upsides that are going to come to this for the country, but obviously, hey, there's some downsides, just some higher interest rates and the Fed not being able to go back to zero as well. And so I think a big reason why we're going to see inflation remain sort of stubbornly higher than that 2% number really comes down to all the disruptions that have happened to global trade and global supply chains in the aftermath of COVID-19, okay? And a lot of people give Paul Volcker credit for fixing inflation in the early 1980s. He's the guy that raised interest rates like 20%. He's sort of seen as like the inflation fighter. And I think high interest rates helped with that. But I think a big way that we solved inflation in the late 80s, early 90s, when inflation sort of fell off a cliff and remained stable around 2% for decades, that's why we all think of 2% as normal. I think a lot of that had to do with globalization. Okay, in 1990, the Soviet Union collapsed. 10 years later, China joins the WTO. What this does is it sparks a huge wave of offshoring in the United States. And the reason why is half the world joined the Western markets. Labor specifically became a globalized commodity, right? You could ship your production facility abroad and save like 95% on your biggest expense, which is labor. And so if you do that, it's going to be great for profits. It's also going to be really good for consumer prices, right? You can pass those cost savings along to consumers. So I think just using cheap labor abroad, that's a big way that we solved inflation last time around. Okay, but the downside to all of this is not only is domestic U.S. labor going to be injured by this, right? You're now competing with someone in China making like 5% as much an hour. But on top of that, okay, we deindustrialized as a country. We shipped a lot of our production to other places. And, this was kind of an okay deal for a long time because the world is very peaceful. America was unchallenged as the world superpower. There was free movement of goods. So supply chains just became extremely complex and very efficient and very long, right? And so as long as everything was working out really well and there was no major disruptions, hey, the system was a pretty good bargain overall. However, when COVID-19 hit, these really fragile, efficient supply chains were completely upended and destroyed, right? And all of a sudden, you know, became much more conscious in people's heads that, hey, we're producing all of our semiconductors like a stone's throw from China, which is our biggest geopolitical rival. We don't make baby formula in the United States enough for our own demands, right? Like we're doing this giant green energy transition in the country, and we don't even produce the windmills and the solar panels and lithium-ion batteries that go into this stuff. And so there's this big realization that, hey, we've gotten way out over our skis with globalization, and we need to bring some of this production back home, not only for our own, geopolitical safety, but just, because, hey, the cheap labor in other countries is drying up anyway, right? We all know that China's population is peak. That's been a pretty widespread headline. And so what you've seen in the past year or so in the United States is a huge reshoring boom. And what I mean by reshoring is just bringing production of certain industries back to the country. And to sort of show this, what I've done here, guys, is I've charted out spending on the construction of new manufacturing facilities. So what this is just like construction of factories in the US, the amount of dollars being spent. Okay, and so what you see is starting in 2022, that's after all the COVID stuff, we're mostly getting back to normal and reopening, but we've seen all these vulnerabilities in supply chains. And on top of that, hey, we've passed this legislation like the CHIPS Act, the Inflation Reduction Act, that's incentivized the reshoring of production. Spending on manufacturing facility construction in the US doubles in less than a year. I mean, it's absolutely gone vertical. And so I think this is really great. It's going to make us more like, self-sufficient as a country. If something bad happens abroad or more conflicts spark off, we'll just be less buoyed by like the geopolitical waves, which I think is a good move strategically. But if all of a sudden, hey, we fixed inflation last time around by outsourcing production and cutting these labor expenses, if now we're going to do the opposite, we're going to start bringing production back to the country, hey, it's just more expensive to pay US workers to do some of this stuff, right? So if all of a sudden, hey, instead of paying someone in China to make whatever it is, we're going to pay someone in, Phoenix, Arizona to do it. It's just going to be more expensive for American workers to, first of all, build all these factories, and then on top of that, staff all of them as well. And so I think what's essentially occurred here, guys, is that the reshoring effort to the United States in the aftermath of COVID has sparked off the first increase in employee bargaining power in the United States in probably 30 years, because we're no longer seeing employees have to compete with people all over the world. And so that's why you're seeing all these headlines about strikes happening, right? Kaiser Permanente or the United Auto Workers, or go down the list. If you look at data from the Bureau of Labor Statistics, the United States, this is a perfect, thank you, Steve, it's a great change there. If you look at data from the Bureau of Labor Statistics, which is what this is, and guys, this is just the number of employees on strike in the United States by month. You can, first of all, see how many people were on strike back in the 70s, right? It's a big part of our inflation problem back then, and then through the 80s. And then, hey, we start globalizing production, and, labor unions just have less negotiating power, obviously, so less and less strikes are happening. Well, here we are in 2023, and I know compared to like the 70s, it doesn't look like much, right? But year to date, we've had more strikes in the United States than any time since the early 90s, right? So we are beginning to see some changes in employee negotiating power. Why this matters, essentially, guys, is if we fixed inflation, if we got it to 2% consistently by outsourcing production, we're going to reverse all of that. I think there's a lot of sticky inflation just by higher wages for normal people coming into the system here. That's going to make it hard to get to 2% inflation on a consistent basis. This doesn't mean it's a bad thing, right? I think it's a challenge for the Federal Reserve. It means they're not going to be able to cut interest rates back to zero. It means we're probably in a higher interest rate environment going forward. Okay, but there's obviously upsides to all of this for the economy as well. And so I think really the takeaway here is, hey, the next leg of the inflation fight, getting from 3.5%, 4% to 2%, is going to be the tougher part of the equation. The Federal Reserve is not going to be able to cut rates significantly, and that's the reason why you're seeing all this volatility or these crazy swings in interest rates at the long end of the curve. And that's really what goes into like the discount rate on stocks, right? That's sort of the important interest rate when we price out financial assets. And so I think we could easily see interest rates rise back up to 5% or more next year. If you're looking at like the 10-year treasury yield, I think we're going to see the yield curve steepen, which basically means, hey, short interest rates at a very low maturity are going to be lower than interest rates that have a long maturity, which it's the opposite, right? The yield curve is inverted. You might have heard that terminology before. And I think we still have a lot of volatility that's going to play out in the stock market. And so if I was going to make my guess and open my crystal ball, I think the overall market can do okay next year. I don't see it having as big of a return as this year, but I think we're going to see a lot of the returns sort of rotate. So maybe see a decline in prices of some of these really expensive, high multiple tech stocks that have benefited from like, the AI hype and things of this nature, and see some of that rotate into the other 493 stocks of the S&P 500, which haven't done much year to date. And so I think, hey, for us to get into a new bull market, for us to see just, hey, consistent stock market returns across the board, what we need to do is, I think we probably will have a minor recession of some kind here in the next year. And we can talk more about that if you guys want to in the Q&A portion, because I know I'm getting here right up on 20 minutes. But hey, we also have to fix the inflation problem, and I think the sort of the toughest part of that is here on the horizon still. And so once we fix those two things, I think that's when we get to a bull market. But until then, I think it's going to be volatility out there in the markets. A lot of people talk about these huge gains in the tech stocks this year, but remember, they all sold off huge last year. So overall, companies like Tesla are still down like 30-something% from their all-time highs, right? So this kind of seesaw, this kind of volatility, I think, is going to remain as we head into 2024. So with that, Steve, I'll go ahead and end my prepared comments there. I don't know if we want to open it up for Q&A or not, but thank you guys so much for having me. Really appreciate it. And I'm happy to stick around as long as your clients have questions for me.
Hey, that was great, Bryce. Thank you very much. Why not toss out the first question? You did speak about potential rotation in the U.S. stock market and gave a great backdrop in terms of the economic picture. Do you want to sort of expand that? U.S. versus international stocks, maybe throw emerging markets into the mix as the first question?
Yeah, so great question. I think we probably will see a little bit of a rebound in international, probably like developed international, just because, guys, you might remember, like in the wake of the Ukraine invasion, Russia cut off the gas to Western Europe, and there was a lot of talk of like Europe freezing, right? Like it was like a cataclysmic event. And like, don't get me wrong, Europe is in recession. They're having a bad time, but the worst case scenario didn't really come to pass. Okay. And so I think stocks over there probably sold off maybe worse than they had to. The ECB has also been hiking interest rates. And so now as the ECB is able to sort of pause rate hikes, maybe even cut interest rates a little bit, and, hey, the worst case scenario is realized, I think there is some potential for some upside, I guess, in European stocks, but just international in general. And if I was going to do like emerging markets, I'd say India looks pretty good to me. They're benefiting from like the friend-shoring, like business coming out of China going there, or like things are coming to Mexico. I like Mexico as well. But big picture, I don't love international when I look around the world. And for the past, I guess almost 20 years now, we've heard about how international is set to outperform because, there's just like a discount to their stocks versus like American stocks. And the problem with that analysis is the fundamentals for the American economy just look so much better than they look for like Europe, for example. And the reason why is GDP growth is just growth in your population and growth in productivity or like innovation. Well, Europe is not very good at innovating, and at the same time, they have very bad demographics, right? Their demographics have been in decline since 2008. It's like this, by the way, all over the world pretty much. India has good demographics, but the United States is sort of the standout. Our demographics continue to rise to the end of the century, sort of like slow and steady wins the race, and we're the best innovators. So I personally, and this is the chart that sort of shows that, right? You can see Japan demographics have been falling since 1990, Europe since 2008, China's demographics have been falling since 2020. India's are going to be booming, but the United States grows for the foreseeable future. This is one of the reasons, along with our culture of innovation in the U.S., why I think this country remains probably the best place to be invested long term. And keep in mind the S&P 500 earns a bunch of its earnings from abroad as well. So I'm personally I don't find like a lot of the international equities to be that compelling. I think there's obviously a case for diversification and everything else, but
Sure.
that's why I don't love those from a fundamental perspective.
Okay, great. We have a question from the audience in terms of your comments regarding the inverted yield curve.
Okay.
And when you thought that the curve, you talked about the unwinding of that inversion, when you think that might take hold and we get back to a normally steepened yield curve.
Yeah, so great question. And guys, historically, the inverted yield curve has been an indicator of recession, right? And I think it's gotten to be less and less valuable as an indicator. And, the big reason why is just the fact, what is the yield curve? It's the price of money at different, maturities, right? And so like prices are very valuable in a market economy because they give us a lot of information. And the problem right now is the past like 10, 15 years, the Federal Reserve has been so involved in the price of money and interest rates, that I don't know how much value or like pricing those are actually coming from the yield curve. Okay. And so, yes, it's inverted. I do think probably next year we will see it steepen. Okay. And the reason why is I think we're going to have a recession. I think if we get a recession, the unemployment rate goes up, the Federal Reserve will cut interest rates. And at the same time, at the long end of the curve, which is much more driven by market forces, is beginning to bounce around because the bond market vigilantes are back, right? The Fed's not just buying all this anymore; it's individual investors, and they're demanding like interest payments for their risk. And so, the longer you lend, the more risk you take. So I think we will see a rebound in interest rates at the longer end of the curve, and we'll probably see rates at the short end fall. But that's going to be a recession that I think sparks that.
I thought I was missing part of the question, but the question is just any input on the current state of U.S. commercial real estate.
Yeah, actually, Steve, I have a chart in the slide deck if you want to click to it. I think it's trouble with commercial real estate or something like that. So we might as well show people this. Yeah, this one here. Perfect. Thank you so much. So, yeah, guys, commercial real estate. First thing I'll say, right, is like a lot of people talk about this, like, hey, couldn't this cause banks to fail? And like, then are we gonna have 08, 09 again? 08, 09 was about mortgages, which are by far like that's the biggest asset banks hold. Commercial real estate's much smaller. Okay, so it's not enough to take down the financial system. But yes, commercial real estate looks like it has a lot of problems. And the reason why is work from home during COVID, like you can't put that toothpaste back in the tube. And so what I've done here is I've pulled data from a company called Castle Systems. And what they do, guys, they do the swipe in badges for like office buildings and like skyscrapers. And so this is like a 10 city average that they've done here. But what it shows is how many people are swiping into office buildings versus like the pre-pandemic level, right? Which pre-pandemic was 100%. today, even 3 years after this pandemic, we're still seeing roughly 50% less people going into offices, at least based on this data set, than pre-pandemic, right? And so 50% of demand for commercial real estate based on this data has disappeared, like in a structural sense. I don't think we're going to see all of a sudden a huge boom in demand for office space at this point, right? And so that means, hey, not only is like 50% of the demand for your product gone, but now you're going to have to like roll over your loans at a higher interest rate. This is like a bad business model. And I think we could see, some of these companies go bankrupt or walk away from the loan. And, obviously banks, if they're left holding the bag there, and they have too much exposure, you could see anecdotal bank failures happen, like we saw earlier this year with like Silicon Valley Bank. So I don't think it's going to be enough to take down the whole financial system, but you could all of a sudden like wake up one day and see this on the news, and it could cause like a psychological panic, I suppose. But no, commercial real estate looks like it's in a tough situation. No question about it.
Do you see it? Do you see it seeping into any other parts of the credit markets?
Not. I guess like just generally speaking, the bank failures earlier this year, we saw small like regional banks lose a lot of their regulatory advantages, right? So they're just going to have to pay higher prices for like, the insurance on their deposits. They're now going to have to deal with higher like capital ratios, which will weigh on their earnings. And so, maybe there's some less loans that happen, or the loans that are made by regional banks are going to have higher interest rates. But I don't see this necessarily like spilling over and causing like a domino effect.
Okay. The next question is your commentary earlier on the stickiness of inflation, particularly within wages. What do you think is the probability of us moving into more of a stagflationary environment? And if you want to just,
Yeah. Well, stagflation, guys, is typically so what this comes from is the 1970s. Okay, the experience then. In like the economic textbooks at the time, there was this idea that you can either have high unemployment or high inflation. You can't have both, right? Because if a bunch of people are unemployed, how would they have the pay to like go out and purchase goods and services, right? So that's sort of, and then what we saw during the 1970s was both. We had recessions where people became unemployed at the same time that inflation was high. And the reason why this happened, why these textbooks were all wrong, is they were just looking at it from a demand perspective, okay? And the problem is you could have a really big supply side shock that makes the economy less productive, that causes prices to go up massively, even if unemployment is high. And in this case, what that was the OPEC oil embargo, right? The price of energy went up like 4x in a short period of time. And so, hey, this made the economy much less efficient. Energy goes to the cost of everything, so prices went up across the board. And even during a recession where unemployment was higher, prices were still going up, right? And so I don't think we're going to see the 1970s happen again, but yeah, I could see a scenario where like, hey, next year we have inflation still above the Fed's target of 2%, and we see unemployment rise modestly. So I guess it's kind of like just a less severe version of the stagflation, I guess you would call it, of the 1970s. And what kind of concerns me is if the Federal Reserve responds to a recession by cutting interest rates, what that could do is it could spark off another wave of inflation. I don't think it would get back to 9%, but you could see that inflation rate reaccelerate again as well. And, a lot of our progress has been from like, energy costs going down and things of that nature, which are very cyclical, and that could contribute as well. So yeah, I wouldn't be surprised to see higher unemployment at the same time we see inflation accelerate. And at that point, you are going to see the word stagflation start to show up. It's certainly a possible scenario.
Okay. So I guess a related question, do you think there's a chance that the Fed is going to raise their target for acceptable inflation as a result of everything that we've talked about?
Yeah, I guess, if what I'm saying ends up being true, and I mean, like the data shows it's true, right? I guess the open question is, hey, do wages and stronger employee negotiating power feed back into that inflation rate as much as I'm expecting? If that happens, then yes, I think it would not be that surprising to me to see the Federal Reserve potentially raise its interest rate target or its inflation target. I apologize. And they'll say, hey, there's like structural issues outside of our control causing this, right? And the 2% inflation target comes from looking at like 1999 through, 2005 and saying this is now normal. And that my point is kind of like, hey, that's the biggest boom in globalization ever. That's reversing. So isn't that going to make it hard to get to 2%? And so if you look historically longer than just like the past 30 years at the inflation rate, like the real long-term historical average, like 80, 100 years is 3% inflation. So that sort of is normal from a historical perspective. And yeah, maybe that will cause the Fed to raise the target. That wouldn't surprise me personally.
Excellent, thank you. Another question, given the backdrop that you've discussed, are there any sectors within the S&P 500 that you're more bullish on heading into next year?
Yeah, I guess it would be that rotation trade, right? So like dividend payers, like small caps, like value type stuff. This is like the 493 stocks, and then there's the 7 stocks that have driven everything this year. It's widened out a little bit, but that would be kind of what I would expect to outperform. I don't think we're going to see like Tesla go up 40% again this year, right? So that'd be kind of my guess. Right now, guys, look at, and grain of salt with what I'm saying. I'm a macroeconomist, but I do look at the research that like our equity strategists put out, and basically what they say is, hey, we haven't seen these like 7 stocks or like a very small narrow breadth of the market like this since 1999. Tech has outperformed small caps in the broader market by the most since like the tech bubble, right? So that's obviously sort of a concerning statistic is what I would say. But the question is like, are we in 1999 or are we in like 1997 and there's like a couple more years of this to go before you jump ship? And that's what nobody really knows at this point.
Well, to your point, having managed a couple of $1 billion during that tech bubble, I can tell you that when that reversed, I completely agree with you. We had a solid 3-year run in small cap value that completely undid everything that occurred in 1999. So I think from my perspective, you're preaching to the choir on that one. Energy, what's the House view these days on the energy sector?
Yeah, I think, like the price of WTI, I think it's like $65 a barrel or so. Did it go lower than that? I mean, it's been plunging recently. That's what happens to the price of energy in like the lead up to a recession. It's kind of like a cyclical price. Okay, and so I think like the break even or like kind of normal price for oil now, it was probably like $65 a barrel pre-pandemic. Now it's probably like $80 a barrel because the price of all the infrastructure has gone up, the inputs, the labor cost, everything has risen. And so I would expect a rebound in the price of oil. This would probably help the price of energy shares, obviously, and things of that nature. So I guess I think we're just like leading into it. I think we're in a recession last year, right? So I think that's what you're kind of seeing with the energy sector. And yeah, there will be a rebound there.
So next question, and this is, I'm sure, up your alley. So looking at the ISM manufacturing data, are you seeing anything in particular that you find disconcerting, or are you guys accepting sort of the rolling? We've already had sort of a rolling recession through manufacturing over the past couple of years.
Yeah, it's been, ISM manufacturing index has been, I think, in contraction for like 7 or 8 months straight at this point. So that typically is indicative of a recession, but then at the same time, like it's important to remember over time, the U.S. economy has become less and less driven by manufacturing as well. The service sector sort of dominates. And so I think basically what we've been seeing is like a rolling recession in consumer goods for the past, probably year and a half. And like services have been recovering the whole time and kind of driving things or keeping us out of recession. So it's really what I'm looking for is more weakness in the service sector. I think that's what's ultimately going to be like indicative of the recession beginning. Because yeah, I mean, I don't think manufacturing is going to get like really strong here. I made the case to you guys, hey, like we're reshoring all this production. Keep in mind that's for like business equipment production, right? Like for like semiconductors and like windmills and solar panels. That's not like end consumer goods, right? And that's what dominates like GDP, and it's what's going to like mostly drive the ISM manufacturing. So I think consumer goods has been falling for a while, right? Like I'm not going to Home Depot 3 times a week anymore, like I was in 2020, and
Right.
buying like every Ryobi tool anymore, right? So yeah, I think there's been a rolling recession in manufacturing. It's the service sector that has to weaken for me to get like more concerned about the recession like showing up here.
Right, but right now PMI in the services side has been halfway decent. So I mean,
Yeah,
is that
exactly.
so? Just keep one eye on that in terms of looking for a broader slowdown, maybe.
Yeah, I think that's the right kind of way to look at it.
Okay. Let me sneak in a question because one of the things that I get very frustrated with is to me the misunderstanding that is perpetuated by both the financial community and the financial media in terms of inflation in general.
Mm-hmm.
If you look at the last, COVID the post-COVID years, right? We've had approximately a 30% rise in the general price level, kind of across the board.
Yep.
Right. So to your point that the inflation, the rate of change of inflation has gone from 9% back down to around 3%. That is now still off of a base that is 30% higher
Yep.
than it was prior to COVID. And I would argue a very small percentage of Americans could describe the difference between inflation, deflation, and disinflation.
Yep.
And I think to a certain extent, the financial media does a disservice because everyone hears these words about disinflation, and all that means is prices are just not going up as rapidly as they have.
Yep.
And everyone is now just, put this in quotes, suffered through a 30% rise in the general price level. And I don't think that the administration or the financial media are doing themselves a favor when they don't acknowledge really what's happened in the economy. And I think to me, it's certainly a part of the polling problems that the current administration is having in terms of just the general public.
Yeah.
I just wanted to see if your thoughts on that.
Well, it's funny, like you mentioned, the general public isn't like familiar with the difference between these terms, and like I don't think it's like I don't think the White House is that familiar. But President Biden, I'm sure it was his intern or something, right? But they just like tweeted out, "Hey, inflation has been falling or whatever because the inflation rate's down from 9 to like," but it's the prices aren't falling, like they're just going up more slowly to exactly what you've been saying, right? So I think the economic literacy goes all the way to the top. And yeah, it's just to focus on like winning political points rather than actually addressing the overall problem here, which is that, yeah, the total amount of money in circulation went up by 40% in 2 years. And so, yeah, the general price level is probably going to rise to reflect that. And unless we pull out a bunch of money out of the system, which we're not going to do, because there's all these issues with like, debt obviously being fixed rate, and we're a very indebted economy. If you saw deflation happen, it would be there'd be a lot of issues, right? Very negative economic repercussions. So yeah, I mean, we're not going to actually see prices ever fall back to where they were. We've just readjusted to a newer, higher price level. It's my view.
Well, all I can tell you is being a trained monetarist from the early 80s, I can tell you that in my case, you're preaching to the choir.
Yeah, I'm glad I started with an M2 slide then.
I certainly appreciate it. I think we're kind of running out of time here, Bryce, but I want to thank you very much for taking the time to enlighten our friends and the audience today. And I want to thank everyone who has taken the time to listen to Bryce. And from 12 Points, wishing everyone happy holidays and a healthy and happy new year.
All right, guys. Well, thank you so much for having me. Happy holidays, everybody. Hope you have a good one.
Thanks again, Bryce.
Yep. See ya.
Bye.